It's interesting because the news headline will be all-time high. S&P 5 is up, call it close to 10%. You will say that earnings are strong the way you started, but I will caution that in a way because if discount for growth and you're looking at the yield you're getting and you compare it to the 10-year treasury, you're pretty much getting the same. And so your caution valuation is pretty much gone. And that's the part that I'm most concerned about. I think the headline news is good and we are getting the AI groove or Kool-Aid, so to speak. I will caution on the fact that investors are actually not compensated for the risk they are taking in equity markets. And I think this is the big headlines here.
So then if bonds no longer diversify portfolios the way they once did, then what's the biggest mistake allocators are making right now? And what should they replace bonds with?
Sure, I think the bond serves in a caution way, but if you look at since 2022, the correlation between the equity and bonds has been positive. And for a long time, the inflation regime and the rate regime was making that diversifier a key part of the ever so low fiduciary balanced portfolio. Now, what investor needs to do is actually to earn deeper and diversify the diversifier, for the lack of a better word. And so you need to go into other asset classes. One that I like a lot is actually real assets, because you're actually earning both the exposure to the real economy, but also you can have an inflation edge. Think about listed infrastructure. Think about natural resources. And so you're getting the cash flow from toll, you're getting cash flow from rental yield, and all that allows you to diversify that part as well.
So you have a model asset allocation? Do you have a standard asset? How do you think about that?
So we have a model asset allocation, and also we dive into a 6-factor model that is proprietary. And I know when you have a fundamental manager just before you take is the stock pick of the day, but the part that the quant person is the most excited about is the dispersion of stocks within that bucket. So let me tell you 2 sub-factors that I'm the most excited about. Value is back in fashion.
Okay.
For all of us who've been around for a long time, value was sitting at the bottom of the market returns. And the past 3 quarters, value is up. This year, up 19%. And so that's the part I'm excited about. The other factor is momentum. Momentum is at an all-time high since the dot-com era. We don't talk about it enough. But within momentum, if you look at your winners and your losers, this is where you have the widest dispersion. So a quant person like me, that's where I'm getting excited.
So the dispersion is what people are talking about. The winners are such big winners, but the losers are kind of languishing there.
Yeah.
How then do you try to build a portfolio where you get a lot of the winners, but you're not overly concentrated? Because before the show, we talked about diversification and how there's a lack of that.
Yeah, it's interesting because the ultimate bellwether index, call it the S&P 5, looks like a diversified index if you buy it on the docket. But once you double click, it's actually 17% of the stocks that actually drive most of the returns. So you are not diversified. Today, it's a semiconductor bet with pretty much 85 stocks. And so what I like to tell investors is that you need to know your benchmark and how you think about that. If you're only getting a subset of diversification to an index, it's important to look at active managers that can add that value. And so for me, this is the main point here, is that avoid to be hyper-concentrated. Think about other ways to get your return outside of this AI-only play.
So don't buy the S&P?
You need to diversify that S&P by other ways. So S&P is just a market cap. Market cap is one way to get exposure. I always tell clients you have thousands of indexes and a way to slice and dice the markets. I will actually lower my exposure to S&P 5 as a pure indexer and look at momentum and value as complementary.